And how much is the value of the bond? According to you, what is the liability? 100,000, and the price value you receive 96,149. So difference is called discount. And what we call that discount is debit balance. So cash received. So when you issue the bond, cash is inflow. Cash increase. Cash increase means cash on the debit side. So 96,149. Discount. Bond discount is the difference between 100,000. How much is that? I think 3,000 something. So let's see here. Cash and discount 3851. And what is the bonds payable? Bonds payable is 100,000. That is our liability. All right, guys, understand this entry here?
Yeah.
Yes.
Or should I repeat one more time? Everyone is clear? Momo?
Yes, sir.
Good. Miria? Priscillo? Pavaroon?
Yes, sir.
Noon?
Yes, sir.
Apollo? Good.
Yes, sir.
Let's move forward. Now let's talk about the how they are written on the balance sheet. So this is the balance sheet equation. So we are not covering this. Just focuses here how this is written on the balance sheet. So on balance sheet under the current liabilities, there is a long-term liability. All right. So in long-term liability, you will write down bonds payable at 9%, due in 2019, 5-year, less the discount. So discount is 3,851. So right now the market value or the book value of the bond is 96,149. All right, done. So it means after 5 years, how much you have to pay back? So it means the discount is going to decrease and book value is going to increase until it becomes 100,000, because after 5 years you have to pay back 100,000, not this 96,149. So let's see that how this is possible. So we have all the data here. So remember here the issue date is January 1st, 2014, and why we are paying close attention to the dates? Because there is interest expense included. All right, and then we make the entries. Entries are affected by the dates as well. All right, and also the expense going to be affected by the dates as well. Maturity date is January 1st, 2019. So difference is 5 years. It means this bond is issued for 5 years. Face value 100,000. All right. Stated interest rate is 9%. So remember, 9% means interest always given you annually, but the payments schedule are given to you after that. So 9% semi-annually means that the yearly interest rate is 9% and yearly payments are 9/2, which is 4.5. All right. So always interest is given to you on annualized basis, and the payment is given to you right after this. So this is just for your information that 9% semi-annually means the payment is 4.5% every 6 weeks. 6 months, not weeks. And interest period, interest paid semi-annually on this date. Right? And remember, because our books closes at 31st of December. So payment is going to be on next year, but the expense belongs to 2014 expense belongs to total 9%. But the payment is, of course, is gone to the next year. So we'll see the treatment. So market interest rate is 10%, which means 10% semi-annually means 5% every 6 months. So you see 10% and 9%, it means bonds are issued at discount. And bond value is 96,149. So where this value is coming from, this is the present value of all cash inflow, and we normally learn it in finance to calculate that. So we are not calculating it here, rather we are just seeing the accounting treatment of bonds payable at discount. Okay, so how to calculate this we will learn in financial management, in finance, when we try to calculate the value of the bond, we learn over there. Okay, so please don't ask question how we get this figure. We will be learning this in our finance class. All right. Okay. So the due to this abnormality, because we are receiving now 96,149, but we will pay after 5 years the 100,000. So there is a difference, and the difference between interest payments and interest expenses. So remember, interest payments are always on the promise, and the promise is interest payment would be stated rate on the face value. So remember, interest payments are based on face value. What is interest payments? It is 9% divided by 9% multiplied by 6 by 12 multiplied by this 100,000. That's the company promised to pay. And interest expense is based on market value, market interest rate, and market value. Market value is right now 96, and market interest rate is 10%, and 10% semi-annually means 6 by 12. So did you see something that in discount, interest payment is different, interest expense is different, and interest payment is in cash because company promised to pay in cash based on future face value and based on coupon rate. And interest expense, which will go to income statement, it is based on the market value and the market interest rate. Are we clear here? So we having two interest figures, right? David, Oliver, Mirko, Marco, Noon, Momo, Priscillo, Miria,
Yes, sir.
Subhan, Fai,
Yes, sir.
Yes, sir.
Havarun.
Yes, sir.
Good. So how we calculate here the interest payment? Interest, remember in payment, whenever we read the payment, remember this is backed by cash. All right. Whenever you heard the word on account or on credit, remember that is liability. We will pay in future. But payment, the liability, which means cash is decreased. So payment belongs to face value multiplied by coupon rate multiplied by the payment pattern. Semi-annually, 6 by 12, 4,500. What is interest expense? The expense is market value multiplied by 10% the market interest rate multiplied by the payment type, payment structure, semi-annually. Did you notice something? Our interest expense is greater than interest payment, which means our income statement will record interest expense as 4807 on yearly basis, on 6 months basis, while our cash is going on at 4500. All right. So it means in discount, when when bonds are issued at discount, interest payment is always less than interest expense. All right. So that would be a very good MCQ here. So now how the interest payments are going to be issued and how the, here, let's just create the amortization table so that you understand what's going on. So this is 5 years, 1, 2, 3, 4, and 5. So in every year there we have to pay 2 times interest. So they're going to be 6 months here and the other 6 months here. So remember, interest payment because interest payment is based on stated interest rate, coupon. So every 6 months you pay the promised payment. All right. Interest expense. Interest expense depends on here. We have discount and we have balance, the market value of